Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Well said, Mr. Einstein, well said. Now, while I'm pretty sure he wasn't trying to give any financial advice, even years from now, his words make a whole lot of sense. Hello and welcome back to Tide to Wealth, where you are just one sale away from reaching financial success. Compounding really is the eighth wonder of the world, and it really can make a massive difference to your investments. Think about it. When your money is earning compound interest and you don't take a single penny out, it grows exponentially. Just take a look at this graph. This is exactly what ends up happening to your assets, and why the strategy of compounding can turn super modest investments into reasonable wealth over time. In today's video, we're going to talk about the 8 best compounding assets to start investing in now. And we'll also talk about how they'll benefit you and their potential returns. Doesn't matter if you're just starting out your investment journey or you're super experienced. What we're going to talk about today could be exactly what you need to know to be wealthy a few years down the line. But before we talk about anything else, let's talk about what compounding is. Compounding is the process where the value of an investment increases because the earnings grow as well. Okay. I know that's confusing, but let me give you an example. Let's say you invest $1,000 and you earn 10% annual return on those $1,000. In the first year, you're going to earn $100. Now, your new balance is $1,100, right? Well, next year, you're going to make 10% of that balance, which is going to be $110. If you let this process go on for about 20 years, you're going to have $6,727.5. That's a darn good investment, don't you think? $5,727.5 in 20 years. That's impressive, honestly. But the way compounding works, if you wait 10 more years, you're going to have a whopping $17,449.4. So while your investment of $1,000 goes to almost $7,000 in 20 years, in 30 it goes to 17.5. This means if you're thinking about saving up for retirement, the earlier you start, the better it'll be. Now, this same principle of interest won't specifically apply to all investments, but there are still certain investments where the concept exists, and let's start with the most obvious one, real estate. Telling people to invest in real estate is super cliche, isn't it? But there's a reason why it's one of the most common forms of investment, and that's cause it's the most lucrative form of investment. This asset is tangible and it appreciates over time, and for many years it's outpaced inflation. If you want to make real estate a compounding asset, then you better invest in rental property. Again folks, this is no professional financial advice, but considering how good of a deal this is, you might want to look it up more. Rental properties can be an amazing asset. However, they're even better than owning your own home. In terms of positive cash flow, it could generate quickly. Think about it, the rent can cover the property's expenses and mortgage. At the same time, the property will also appreciate. Once the mortgage is done, you've got an extremely expensive property that's all yours, and you can either use the rent as income, or you can just sell it off and retire. Or if you're hungry for more, you can buy an even bigger property and rinse and repeat the process, thus creating a compounding effect. So, if you repeat this process several times, you'll be worth a lot more than right now, and using the compounding effect, you can move on to bigger and bigger properties. But not everyone can just turn up and purchase a property. That's something that requires a lot of capital, a good credit score, and it also requires time and patience. So, if you can't do that right now, then you better invest in stocks first. Owning a certain company's stock means you own a small piece of it, and well, that can offer you massive returns over time. As the company grows, it profits more, and the value of your stock starts to increase, and well, your capital starts to grow exponentially. But that's not all. The reason why stock can be a compounding asset is because of dividends. A dividend is basically a share of the profits of the company that you get based on what percentage you own. Now you could choose to spend your dividends on whatever the heck you like, but if you start investing that money back into the market, the next year you're going to get an even higher dividend. This means if you repeat this process a few times, you'll have generated quite a lot of wealth. Let's play out a little scenario for you. Let's say you invest $10,000 in a dividend stock that has an annual return of 12%. This annual return combines the appreciation of the stock price on top of the dividend yield. Now let's say you were extremely patient, didn't take out a single penny, and you reinvested the dividends. In 30 years, the value of your investment could be $300,000. Now don't get me wrong, you can still make money on the stocks that don't pay dividends. They appreciate in value as well, it's just your investments won't reach as high as it would have with the dividends. Now let's say you're an extremely busy fella, and you just don't have the time to reinvest your dividends again and again. Well, there's a solution for you there too. You could always just put your money into dividend reinvestment plans, also known as DRIPs. DRIPs basically reinvest the dividends from a stock into buying back more shares of a company. Well, you can obviously do this for yourself manually, but DRIPs does it automatically. You won't even need to lift a finger, and the system will compound the growth of your investment over time. On top of that, you won't be paying any additional transaction fees, so you can put your money into a dividend reinvestment plan and just forget about it for a few years. But look, if you've never invested in the market before, that's fine. Everyone's got to start somewhere. But the point is, the sooner you do, the better off you'll be in the future. However, that's not the only reason you should be getting into stock. Look, real estate is an amazing investment. However, it's just not as liquid. If you suddenly need boatloads of cash, you won't get it by selling your house, since it's a long, painstaking process. However, stocks are super liquid. They can be bought and sold quickly and easily. So if you're worried that a company's stock is about to tank, or you just need cash because you found a better place to invest it, then all you need to do is sell your stock and you'll have money in no time. By the way, if you're enjoying everything in this video so far, we'd appreciate it if you can just like and subscribe. Stocks are a great idea, but if you're one of those risk-adverse folks who just want to invest but think the stock market is too risky, then don't worry, because you can just invest in bonds. Bonds are another great place to put your money. A bond is a fixed income instrument that represents a loan made by an investor, that is you, to the borrower, which is usually a government or corporation. It's not the most attractive form of investment, it's not going to give you the best of returns, but it's one of the safest. If you're buying bonds offered by the US government, chances are your money's safe. And how does compounding add to all of this? Well, it's the same as stocks. Buy a bond, use the income from that investment in more bonds, and repeat. The more bonds you have, the more interest you'll earn, and the more money you'll be able to invest back into those bonds. The more you repeat this process, the higher the compounding effect will be. But okay, let's say you're not fully satisfied by the low returns of investing in bonds, yet you're uncomfortable investing in stocks because it's too risky. Then where should you invest? Well, this is where mutual funds come in. Mutual funds are another compounding asset that you need to start investing now. It's a diverse portfolio of stocks, bonds and other assets, which means that the risk is reduced and the growth is going to be steady. Again, you're not going to make crazy returns, but it'll be solid enough. And then when the money starts coming in, all you need to do is reinvest it into other assets, thus leveraging the power of compounding. Let me give you an example. Let's say you invest $5,000 in a mutual fund that gives you an annual return of 12% over 30 years, which you then reinvest as well. On top of that, you put in $2,400 of your own money every year too. In total, you'll have put in $77,000, so your investment should be worth around $300 grand, right? Nope. It will be worth $728,998. This is exactly how powerful compounding is. However, if you think that's a long process and it doesn't pay you well, you can always just start your own business. Because here's the thing, this is by far one of the most compounding assets you can invest in, but it's also risky. Starting your own growth-orientated business can provide you with some massive returns. Your business will grow, you'll invest the profits back into it, and the initial investment will continue to multiply. Let's say you start a restaurant, then you start another, and then you start franchising, getting a cut from someone else's investment and work. So if you're looking to put your money somewhere, and you've got the time, starting your own business could be a super solid idea that will compound your investment over time. But considering how much of a risk this can be for some, you can always invest in digital assets too. Right now is the perfect time to invest in digital assets. The world is more connected than ever before, and even the remotest of areas are now getting access to the World Wide Web. Let's say you're great at talking about football. All you need to do is start your own YouTube channel, and after tons of hard work, your investment is going to grow rapidly. Heck, you could even invest in a website that's revenue generating, or even a blog. Each and every penny you make can be reinvested into more digital assets that will bring even more capital in the future. I don't know about you guys, but this is sounding like a win-win to me. And the last is probably the least. A high-yielding savings account is where it's at. A high-yield savings account is basically an account that pays better interest rates on deposits than the usual rates. These accounts allow for your money to grow risk-free, and they're perfect for short-term savings. Investing in the stock market is a great idea, yet you do have to deal with volatility, unpredictability, and bad economic situations. With a high-yield savings account, you won't have to worry about any of that. Now, you can opt for something that will compound your interest daily, or something that will compound your interest monthly. What's better? Let's find out. Now, we all know what compounding is. If you have $100,000 in the bank with a 3% annual interest rate, you'll have $103,000 at the end of the year. And then the next year, the 3% will be applied to the $103,000, not the $100,000. Yada, yada, yada. But whether that interest is applied daily, monthly, or annually is where the difference is at. Every example we've talked about so far applies to the interest annually, but with a high yield savings account, it can be applied daily and monthly too. In the example I just mentioned, your monthly interest would be 3,000 divided by 12, which is 250 bucks. So instead of 3,000 being applied at the end of the year, 250 will be applied at the end of the month. So next month you'll have 100,250. When the 3% is applied to that, your interest earnings will be 3,007.5. So when that's divided by 12, you'll earn 250.625. In other words, almost 63 cents more than the first month. Doing the same calculations, your interest in the third year will be 251.25. At the end of the year, your total interest earned will be $3,041.60, $41.6 more than what you would have annually. Now, what happens with daily compounding is self-explanatory. Instead of interest being applied at the end of every month, it's applied every day. So the first day you'll have $100,008 and so on. With the daily compounding interest, you'll have $3,045.33 in profit, which is more than the $3,041.60 you'll make with the monthly compound. It's not a massive difference, but hey, a free cup of small coffee every year doesn't sound too bad. So folks, these are some assets that you can invest in to truly leverage the power of compounding. The earlier you start, the better it is, since your investments have more time to grow. However, whenever you're investing, please do thorough research and consult a financial advisor before making decisions that could drastically change your life. Well folks, with that said, let us know in the comments what you think is the best asset to compound your money. See you next time.